So I want you to explain gold mutual funds to me.
Yeah.
Now gold is at a very high price, right? So if I want to still allocate 10% of my portfolio in gold,
Yeah.
how do I do it through gold mutual funds? Explain it to me like you would explain it to an 8-year-old child.
Yes. So if you want to put 10 rupees out of your 100 rupees into gold, and if you are doing it all as part of your investment and not as part of your jewelry is okay, you can't question that.
Yeah.
Other than that, the entire 10 rupees should go into gold mutual fund. Now, there are two products that exist in a gold mutual fund. First is gold ETF, which is an exchange traded fund, which you can buy onto the stock exchange between, let's say, 9 to 3:30 and buy at any point in time. And second is a gold fund of fund, which is built on this ETF, right? So when you buy a gold fund of fund, mutual fund, they eventually go and buy the ETF, right? Anybody who is active on the stock investment side and do a lot of stock investment, they should ideally put all of their money through ETFs. And I'll tell you why. Because ETF has an expense ratio, and let's take any AMC which has a ETF ka expense ratio, which is managing the cost of that mutual fund, which the money that goes to AMC that you pay from your returns. And that is a 30 basis point for a ETF, for example. If you build a fund of fund on that, you will pay for this 30 basis point. You will also pay for this mutual fund cost. So you eventually pay 30 plus, let's say the mutual fund is charging 20 basis point more. So if somebody is buying a gold mutual fund, they'll pay 50 basis point. But that same ETF, you can buy it at a 30 basis point. But it requires understanding. You need to have a demat account. You need to go to your exchange and trade that, right? And when you have to sell, you can sell it not on the weekends. You can just sell it during that ETF working hours and all of that. But if you are active on the stock market side, put the entire 10 rupees on the gold ETF. It'll be cheaper, better returns for you.
So how do I do gold ETF investing?
You go on to your any broker that you have, let's say Grow, Zerodha, HDFC Securities and all of that. And you will find that there are Nippon Gold Bees and there are multiple mutual funds who have their gold ETFs live onto the platform.
So you pick any one, is it?
You should pick the one with two conditions. First is there has to be high liquidity on that ETF, because if there is no liquidity, you will not get the best price, right? Generally, I have seen maybe Nippon, because this is the oldest gold ETF, they have a high liquidity. Second is you should look for the expense. Different mutual funds or different mutual funds charges different expense for the same, right? Some will charge low, some will charge high. So depending upon liquidity and their expense ratio is what you choose, and you can stick with it. Otherwise, underlying product is all same. There is no fund manager to that, so you don't have to worry about that.
And there's no moving in and out either, right? I mean, it's just one product.
It's just one product.
Regulated, yeah. So which are the top 3 or 4 gold ETFs that you like?
I personally do 2. I do Nippon gold ETF because it has a high liquidity and high volumes. And then I do Grow gold ETF because it has the low expense ratio. And I use Grow for my trading. So these are the 2 ETFs top of my mind. Others I have not seen, but there are multiple. There is SBI, there is ICICI. ICICI also has as a mutual fund. ICICI Prudential has the lowest cost gold mutual fund, not ETF, but the mutual fund, because they charge low on the ETF. They also charge low on the mutual fund. So the sum of these 2 is the lowest for the ICICI Prudential Gold mutual fund. So that's how you should see. But if you are looking through mutual fund, then don't just look at the expense ratio of the mutual fund, because sometimes you will see that a mutual fund which has the lowest expense ratio still charging you more because the underlying ETF has a significantly higher expense ratio. So look at the underlying ETF's expense ratio, look at the mutual fund expense ratio and do that. And I have done this study maybe a couple of months ago, the lowest was ICICI.
Okay, interesting. And if someone is in the age group of say 25 to 40, what percentage of their money should be in gold?
See, by the time you reach 40, it should be 10%. Now, there are 2 ways of doing that. First is you do SIPs and say that every 100 rupees I invest, I keep investing 10 rupees in gold at whatever price it is. Or
even if it's at the price that it is today.
Yeah, even if it adds the price, because what you will always see is, and that's very interesting thing that I have learned, that, and you can do your maths maybe from wherever you are, a 1 kg gold 20 years ago would buy you a house. A 1 kg gold today will also buy you a house, and 1 kg gold after 20 years will also buy you a house, right? So the same
Not a house in Mumbai.
Not a house in Mumbai. But the 1 kg gold 20 years ago, if that is buying a house in Mumbai, maybe that.
In Panvel, maybe.
So that's the best inflation beating product. So, आप किसी भी price पे करो, you should not think of that as short-term returns, right? Because this price will go from 1 lakh to a 90,000 or 80,000, or could go up to 1 lakh 30,000. But this price will keep going up. So that is one way. Or other way is because you want to be opportunistic. What you can do is you can do lump sum investment wherever you think there is a right time. Mm-hmm. And let's say that I'm regularly not investing in gold, but I have invested, let's say, 1 lakh rupees so far. And suddenly I see the opportunities. Next 10,000 rupees, I'll completely invest into gold and make that portfolio as 10%. Mm. So that's on gold. I personally feel that silver should also be part of your portfolio. Only 2% of your portfolio should be silver. And these are all my personal investment strategies, not the recommendation.
No. I mean, fair enough. And I want to talk about silver because silver is a product that nobody talks about.
Yeah.
And very few, I mean, the large usage of silver is in industries, and that's why it's getting so much traction these days. Yes. Silver is used across industries, whether it's in semiconductors, whether it is in auto, but nobody talks about it.
Yeah.
Why is that? And what is the scope as an investor in silver?
Yeah, I think, nobody will talk because there are so many things to talk.
Yeah.
Right. So, and that's why nobody will talk, and that's still very small part of your investment. So, I don't think people will go and talk about it. And you should also not think a lot. Why I'm saying 2% is because it behaves like gold. You might get the similar or slightly higher or lower appreciation on silver. But because what you said, right, because of the industrial usage, the volatility in silver is so high. Right? You should not put more than a significant amount into silver, but that should be part of your portfolio allocation. Some people buy silver, keep it, but there is a storage cost. I feel that again, the silver ETFs are the best ETFs to do that. Again, for silver, I've done similar Nippon, again for volatility, but that should be 2% of your portfolio. So gold 2%, gold 10%, silver 2%. And let's say 40% on the fixed income side. That's how you should do it. 60% then you do equity, some direct stock, some mutual fund, whatever works best.
So you guys don't want to get into equities?
Okay, maybe the first time on the show I'm saying that we want to get into equities because we believe that the aspirations of my customers are there. They want to make money.
Correct.
The only difference in my customer and maybe a lot of people that generally you talk to, their full-time job is investment. My customers' full-time job is something else.
Correct.
They run their shops, they do their jobs, they're doing a lot of other things, freelancing and all of that. That's their job, right? And I'm attracting those customers that I will take care of your wealth in the way ideally it should be. So that the average return that you guys will get will be higher than if you do it on your own. So that you can focus on earning more money than growing money through wealth. And these people also have aspirations. And if we are able to build that trust, we'll be able to move the customers from fixed deposit to bond, to gold, to debt mutual funds, to eventually equities as well. Now, maybe our name will come against that you say stable money and then these products, but that's a good problem to have. But that's how we see that. Maybe not now, maybe 4 or 5 years down the line, but we want to offer the full stack service about the wealth to my customers.
So stable to unstable money across the spectrum.
No, I'm just saying stable money to maybe just stable. That's the name that we would go.
But I mean, I'm someone who's been investing in equities for the last 15 years. Yeah. And I can tell you with certainty, because it's a use case for me, that equities it's magical with the power of compounding, right?